In 2023, the natural gas market witnessed considerable volatility and a general decline in prices, signaling a challenging year for market performance. Throughout the winter heating season, the U.S. benchmark Henry Hub spot price, a crucial gauge for nat gas prices, averaged approximately $2.80 per million British thermal units, showcasing a significant deviation from earlier projections. This decline in prices was primarily attributed to a surge in U.S. nat gas production, reaching unprecedented levels. In November 2023, daily production averaged around 105 billion cubic feet, contributing to a market oversupply. Moreover, the heightened production levels, combined with milder winter conditions, led to decreased consumption and subsequently increased storage inventories. By the end of November, storage inventories surpassed the 5-year average by 7%, applying additional downward pressure on prices. In 2023, persistent concerns over inadequate nat gas supply and record-breaking heat in the United States fueled a steady uptrend for 7 months. However, this trajectory came to an abrupt end as prices collapsed, owing to robust production, ample supply, and a significant drop in crude oil prices. Additionally, an exceptionally warm winter start further contributed to the challenges faced by the natural gas market during this period. The weather patterns observed in 2023 played a pivotal role in shaping the demand for nat gas. The mild winter experienced during the traditional high-demand winter heating season resulted in reduced consumption, significantly influencing market dynamics. The Energy Information Administration anticipated near-normal weather conditions for the remainder of the winter heating season, indicating a steady demand for natural gas for heating purposes. However, the presence of unpredictable weather patterns, including the potential for milder winters in the northern U.S., introduces the possibility of lower than expected demand for heating. This, in turn, could impact both nat gas prices and overall market stability. Notably, weather-adjusted power burns of nat gas remained robust in comparison to the preceding summer, driven by factors such as coal-to-gas switching and warmer-than-normal temperatures in the third quarter of 2023. These weather trends are poised to continue as a critical factor influencing the natural gas market in the year 2024. Entering the year 2024, the nat gas market confronts various challenges, encompassing geopolitical tensions, economic variables, weather unpredictabilities, and fluctuations in production and storage levels. Events like the potential loss of the Nord Stream pipeline and the prospect of supply disruptions underscore the market's susceptibility to geopolitical pressures. Global inflation concerns and an economic slowdown have the potential to dampen demand, while unforeseen weather patterns may result in lower than anticipated heating requirements. While ample underground gas storage inventories may act as a stabilizing factor, an oversupply scenario could also materialize, exerting downward pressure on prices. Notwithstanding these challenges, 2024 presents several opportunities for the nat gas market. The escalating global demand for liquefied natural gas, especially from Mexico, coupled with sustained demand for U.S. LNG exports to Europe and Asia, offers substantial growth prospects. The emergence of new industrial projects and the continued growth in U.S. nat gas exports to Mexico provide significant avenues for expansion. Furthermore, the ongoing phase-out of coal-fired generation and the installation of new renewable energy sources may result in an increased reliance on natural gas-fired generation, at least in the short to medium term. To sum up, while the nat gas market grapples with risks tied to geopolitical tensions, economic conditions, weather uncertainties, and production levels, it concurrently stands to benefit from rising global demand, structural industrial expansion, and shifts in energy generation preferences. These opportunities have the potential to offset the risks and contribute to a more resilient and dynamic market in the year 2024. As we look ahead to 2024, the global economic landscape is poised to exert a significant influence on the demand for energy, particularly in the realm of nat gas. Projections indicate a gradual recovery from the recent economic slowdown, with emerging markets potentially spearheading this resurgence. However, persistent concerns about global inflation, notably in Europe, may impact industrial and commercial energy demand, subsequently affecting nat gas consumption. In the North American gas markets, a period of weakness is anticipated to persist into early 2024 due to a confluence of factors. These include higher than average underground gas storage inventories, the potential for warmer than normal winter temperatures, subdued consumption from industrial and commercial sectors, and robust production growth from key U.S. basins. These factors are expected to maintain nat gas inventories at elevated levels throughout the winter, exerting pressure on prices in the short term. Nevertheless, as the year unfolds, there is an anticipation of a gradual tightening of the U.S. supply-demand balance, potentially leading to an uptick in spot gas prices. The forecast for the NYMEX price for the entirety of 2024 stands at an average of $3.50. Upon scrutinizing the nat gas market for the year 2024, a notable feature on the chart is the relatively straight trajectory of the 200-week moving average line. This pattern implies that this particular price level is poised to exert a significant influence on the price direction throughout the year. The failure to surmount and sustain a rally above the 200-week moving average is anticipated to maintain downward pressure on prices. Additionally, a descent below the weak side of the 50-week moving average and continuing on a downward trend could trigger an acceleration towards lower price levels. The first indication of strength would emerge with the successful overcoming and sustained rally above the short-term 50-week moving average. Nevertheless, for a shift in long-term sentiment towards bullish, prices must successfully breach the 200-week moving average. In summary, the overall long-term technical forecast remains bearish, persisting as such, unless the market demonstrates an ability to trend higher and secure a position above the 200-week moving average. However, please keep in mind that the fundamentals for 2024 are bullish, so we should anticipate a quick reversal in the technical pattern. Thank you for tuning in. We look forward to seeing you in the next one.